Greetings, Jonathan Camarda, with your monthly market update. And sell in May going way certainly didn't work out, as many times recently has not. And so this May, most of the markets were up over 5%, except for the Dow, which has been lagging. We'll get to that. But most of the markets up over 5%, S&P, NASDAQ, Russell 2000. Technically speaking, again, we've had some real volatility, but when we all shake it all out of the wash, the S&P and NASDAQ are both technically above their 21 and 50-day moving averages, which is constructive. Dow Jones just popped above its 50-day, still a little bit below the 21-day. So what's going on here? What's leading? Technologies have regained the lead here recently with discretionaries. Utilities have been strong. Now, there is a little bit of a bifurcation in belief. Usually utilities are defensive, especially this time of year. However, with the AI boom, utilities, much electricity will be needed to run all these chips and all these technological advances that I can't even comprehend. But you are seeing a boost in utilities, which is a little oxymoronic and has thrown some analysts off, as they're usually a defensive play, but maybe not so much going forward. We'll have to watch that. But utilities, real estate over the last month has popped up. Financials year to date, your discretionaries, technologies, and utilities, top sectors. Energy's definitely taken a pullback here the last couple of months, and it's a supply demand situation. So it's interesting because this is a high driving season as we move into the summer months, and yet energy is weak. And again, there is a thought. Demand slowing, supplies, certainly being on the upside. It's an interesting dynamic that has kept energy under pressure, after some attractive pockets early this year. Again, worth watching. So as we move forward, what we've seen is a little softness in the economy, right? We've started to see cracks in the labor market, and we shall see if that continues. But again, we've definitely seen a lot of companies continue to lay people off, and job openings definitely under pressure as well, and unemployment creeping up as well. So this is really what the Fed has got to watch, because they've been saying the economy's been resilient. GDP's been resilient. Well, I don't know. I mean, GDP has been somewhat anemic, if you ask me. But the market has been buoyed by corporate earnings, and we've had a lot of beats, a lot of surprises. Generally, 2 months into a quarter, where we are now as I'm recording this, you have EPS, earnings per share revisions, usually moving down, has not happened. That's a positive for the market. With all this doom and gloom, the economy is supposed to be really strong, and then the underlying surface of that iceberg that we're all on, jobs are weakening. Labor market is softening. The question is, the Fed has held on. You have some of the hawks on the Fed. We won't name names, talking about maybe more hikes. You got to be kidding me. Higher for longer. But what they're not understanding is, I hope they do, is when the job losses start to hit really fast, everything slides very fast. And then all of a sudden, that change up the Fed thought they can wait on, just kind of be patient at the plate, metaphorically speaking, they're smelling leather. And the market goes, especially the economy starts to really go into a deep slide. And then, of course, once the consumer jobs are weak, can't spend, corporate profits follow. So we hope, again, the Fed has that choking up on the bat there. We shall see. Still projected maybe one or two cuts. A lot of folks are prognosticating tiptoeing around the election without affecting voting. So I guess after the November election, we'll see if some of the job weakness hastens that, when we next hear from the Fed as we move through early summer. Pardon me. Bonds have been catching a bid, so fixed income has been attractive, and in your more conservative strategies, certainly we have positions there to take advantage of that. Now, we still have an inverted yield curve, right? Just for the home gamers again, what does that mean? A short-term, short end of the curve yields are higher than the long end, which usually is a concerning signal. But I mean, this curve has been inverted so long, we can't even remember when it had a normal upslope. It's been a ski slope. And so right now you have in your basically your sub 1 year durations, in the mid to upper 5% range, and then your 2 year and beyond in the mid 4 range. So again, that continues. Now, that being said, some of the softness we've seen, of course, which could be recessionary, dare I say, has buoyed bonds and fixed income as rates have again continued to come down. So again, now that's been a positive for stocks, but on some days now it's starting to show situations where if it really is economic weakness creeping through the door, like the wolf in the back, cracking through the door, that might not be good for stocks if it's a larger picture issue. Again, pivot, asterisk, Fed, do they react? Okay, we'll come back to that another time. So those are the things to watch for. Now here we go. Now some positivity. Be positive, Jonathan, especially as I'm recording this a nice update. Well, yes, and the markets have been constructive on the surface. And so after 5% gains in the month of May, okay, June 83, 84%, don't quote me on the exact percentage, a high percentage of the time has been an up month. And in the mid 60% range, the rest of the year finishes to the positive side after a 5% gain in May. The old sell in May, when that doesn't happen and we have a Cinco de Mayo 5% up, usually it's pretty attractive on the greens for the green team, month of June and the rest of the way. Now, we throw in the confluence of an election year and generally the mostly volatile hurricane season, at least down here in the southeast, folks, and other parts of the country where you have your own, weather issues. Usually it's volatile and maybe low risk exposure time of the year, but in election years, we generally have a drift through the summer months. So again, a lot of confluence and factors there. And then we also have Jerry and the Feds. So how this affects your portfolios, because that's really what you folks care about. We have remained opportunistic with risk assets, especially in more aggressive strategies. And so depending on your risk appetite and how your personal wealth advisor and I also calibrate with current clients, how you're actually deployed. If you're more aggressive with a higher risk appetite, we've been more heavily still weighted in risk assets, and it's paid off because the market hasn't taken that seasonal dive. Because again, we watch it day by day. We don't listen to the doom and gloomers out there. Pick up the mitt, the glove, and the bat. Every day. Did I say mitt and glove? I meant the ball. Okay, so there you go. But final point now I want to bring up: equities and bonds. Okay, now a little bit more in sync. The dollar the last month, of course, has been weak. Go figure, right? Dollar's weak. Bonds have been helped, right? Because rates go down. You've heard this one before. Stocks are obviously some released pressure there. Earnings have been pretty attractive. GDP, jobs weakening. It is a stew of data. Will we have the summer correction or the pre-election year corporate earnings? Maybe some of that weakening, but not too much. Help buoy the stocks higher. Stay tuned. We'll continue on a day by day. Just continue to roll up the sleeves, choke up on that bat. Hopefully the Fed does the same, but we can't control what Jerome does. Until next time.
Hey everybody, Blake Bunch here again, and today I wanted to discuss with you 5 things you got to know about annuities. 1, annuities are extremely complicated life insurance products. That's right, life insurance. They were originally designed for lifetime income, like pensions, but this simple concept has been stretched very thin so that you must read the fine print to understand what these confusing products really do and cost you. Most have high commissions, which are hard to spot. You may hear, "You don't pay a commission, I'm paid by the company," but the truth is, it is permanently comes out of your wealth and typically never comes back no matter how long you wait because of surrender charges or high annual fees. Buying lifetime income can be important, but be careful about annuitizing. Remember, if you were to annuitize, it's an irrevocable turn on of your income. And if rates are low, your lifetime income may be fixed at low payments and it may not be enough to sustain your lifestyle. Annuities have the worst tax treatment in the investment world. They are taxed at the highest tax rate and you get no step up in basis at death. Remember, if you have an annuity product, it's probably a wise idea to have your PWA review it with you to make sure it's in your best interest. It's something that we commonly see and we want to make sure that you understand what you're getting yourself into. If you like today's video, please don't forget to comment, like, and hit that subscribe button. That's it for today. Take care, folks.